I started out as a young developer in Hoboken, New Jersey, and we became one of the largest residential development owners in the country from 2009 until 2016. There's a big opportunity right now, and where I'm investing a lot of my capital is in debt. These high interest rates will subside, but they're never going to go back to where they were 3 years ago. Every one of the operating partners that I invest with has a history since 2019. And all I care about is their performance significantly better than their competitors.
This is your real estate syndication show. I'm your host, Whitney Sewell. I'm excited about our guest today. I know you are going to walk away with a lot of wisdom today from our guest, Peter Fiorette. He's founder and CEO of Mountain Funding and Mountain Real Estate Capital. I've been doing this since 1993, 35 plus years of experience in real estate investing, over $3 billion. And man, you're going to hear just opportunities that he has seen over many cycles, right? Since that time, where he has pivoted, right? He's seen an opportunity and he's pivoted. He's seen another opportunity and he's pivoted. And guess what? He's going to elaborate on the opportunity he sees today in our economy and the cycle that we're in, where we're at. He's going to share a number of those things. He founded the Fiorette Family Foundation. He's partnered with 25 builder developers and developed 400 projects. I mean, he has created one of the largest U.S. residential land and home building investment platforms. He was Entrepreneur of the Year for the Real Estate by Inc. magazine. Just an amazing guy. You're going to hear me talk about him a little bit. I met him over this past year. He is, just a wealth of wisdom, experience, and knowledge in our space. And if you are an operator or passive investor, you're going to learn a ton from Peter today. Peter, welcome to the show. Honored to have you on. I'm looking forward to learning more about you and really sharing you with the listeners. You have so much just valuable wisdom that I'm looking forward to bringing out today.
Wonderful. Looking forward to it, Whitney.
Peter, I was in a mastermind, just so the listeners know, over this past year, and Peter was able to speak there a few times, I believe, and it was just it's very inspiring. His story, his desire for just excellence in almost in just many aspects of his life. And I want to try to get through a few of the, maybe dive into a couple of those today, Peter. But, before we do, obviously you have quite the background in commercial real estate. Give us a high level there a little bit to get us started. Just your journey, Mountain Funding, how that came about, your all's focus a little bit as well.
Well, I started out as a young developer in Hoboken, New Jersey. This is when Hoboken was absolutely nothing. Some of you who have heard of Hoboken, if you have traveled in the New York metropolitan area. And what happened in the early 90s is we had the S&L savings and loan debacle, where many savings loans failed and got took over by the U.S. government, Resolution Trust Corporation, RTC. And when that happened, I saw many of my friendly developers get their properties taken back by the RTC, not because they had bad projects, but because their banks went bankrupt. They couldn't fund interest reserves. And so these good properties being developed by really good developers got taken back by the government. And there was no liquidity in the marketplace. I had been very successful, and my investors had been very profitable and very happy with me. And so what I did is I switched to become a investor and lender to these really competent developers to buy back their really good projects from the government at cents on the dollar. And that's how I started Mountain Funding in 1993. And through that, I grew that platform across the country and became one of the largest capital providers, private capital providers for real estate developers from 1993 until 2006. When 2006 came around, I saw the writing on the wall as to what was about to come in 2007 and 8. I just had that knack of seeing things seemed too good to be true, right? We didn't do any more deals in 2006 and 2007 and sold most of our properties. So when 2008 came around, again, I had very happy investors, very profitable portfolio. Not perfect, by the way. We should have gotten out in a year or two earlier. So not perfection for sure. And we did lose money on a small part of our portfolio. But for the most part, our investors were happy. And so when 2008 came along, it was time to get back into the market in 2009 and focus on the most illiquid real estate product, so to speak, and that's residential land. So if you think about it, residential land is not income producing. And so therefore, it's certainly not financeable. And so in 2009, I started a different platform to acquire with equity as much as I could with large residential projects that were under distress. Again, it wasn't that the projects were distressed, but the financing was distressed. And we became one of the largest residential development owners in the country from 2009 until 2016. And we acquired, developed, and sold about $5 billion worth of land projects. And so at that point, I took another change in my platform. And I decided that investment philosophy had been played out. We monetized it. We did extraordinarily well. And then since then, what we're doing is I have a family office that focuses on identifying top-notch developers and operators who are just really excellent at what they do. Our objective is to supercharge their success with my capital, with my relationships, and my history of wisdom over these many, many years. And so I've got a handful of those developers and platforms who I back with, again, the whole idea is operating on a more strategic investment basis and help them grow in an exponential way that they would otherwise not be able to do without my investment and help.
Incredible. A number of things I want to ask you about there, but Peter, appreciate how you have pivoted a number of times, right? You've been able to see opportunities and you've been able to create a business or an opportunity, for you, your investors to take advantage of that part of the cycle that you were in ultimately. And I know, and I would just want to get right to it because I know the listeners are wondering, okay, Peter, you saw this in 2006 and you pivoted. We'll talk about the other pivot in a minute. You pivoted at that time. I know the listeners are thinking, okay, Peter, what about how does that compare with the right now, right? The current real estate market and what you see happening right now and what you're doing right now and, buying, selling versus, what you saw happening then.
My first pivot was in 93 when I went from pure value-add developer to capital provider, right? When I saw there was more of a need for capital for many guys like me, right? Instead of just growing my own business, I grew others' businesses. So it was 93, then it was 2006, and then it was 2016. And what about today? Great question. So today we have a very interesting scenario. We had what we have. In 2019, things were pretty damn normal for our business. Guys were chugging away and they were doing what they were doing. And, everyone had their niche and things were going fairly well and fairly predictable. And then what happened? COVID hits. And so when COVID hitting, it changed the trajectory of many of these real estate companies and the marketplace. So office is a hell of a lot different today than it was before. For sale housing is a lot different than it was in 2019. Retail hell of a lot different than it was in 2019. Okay, so that happens. Then COVID goes away. And then what happens? Rising interest rates increase at an alarming rate, more so than in the last like 25 years, right? And those interest rates have stuck with us for probably 2 more years than everyone thought they would, right? So that's now a different dynamic. So where we are today, Whitney, these high interest rates will subside, but they're never going to go back to where they were 3 years ago, right? There's too much good happening with our economy, too much good happening in the world economy, and to address the inflation issue, those rates have to stay above where they were before, fighting against the whole COVID thing. So what does that mean? All income property with the same NOI today versus 3 years ago is worth about 30% less, if nothing changed. Now, if you have a reduction of NOI, like office space, for example, some retail space, for example, then values are even going down more than that. If you have asset classes like multifamily, where rents have gone up, NOI has gone up, then that decrease in value has been lessened, but still there. So there isn't one asset class that hasn't been negatively affected by these high interest rates. So what do we do about it? Right? What do we do about it? And some, let's say like office, has had the double whammy, hasn't come back from COVID, probably in some instances won't come back, and high interest rates. So that creates a tremendous amount of positive opportunities. So let me explain what they are. One is developers who are really good at reuse of existing properties, I think, are really seeing their day right now. So let's say you have a retail developer, and he's looking at a retail center that's been affected by COVID, and then values even compressed more because of interest rates and cap rates. But he has a relationship with a different type of tenant base that's in demand and has a lack of supply in that marketplace. And he has a track record. That's the guy you want to invest with. Same with multifamily. Same with industrial. Same with office, like office flex, for example, or industrial flex. Some of that product is in tremendous demand right now with the right developer in the right location. Finding someone who has a history of reuse, I think is excellent. Number two, there's a big opportunity right now, and where I'm investing a lot of my capital is in debt. So what do you mean by debt? Private lenders who are really good in their local markets, find, competent developers with competent projects, and the banks won't lend to them. Oh, wait, by the way, banks won't lend to them. That's another change that happened about over a year ago, is that the banks got hit hard with regulation. And so the government came down on them, particularly the smaller banks and mid-sized banks, and said, you need to reduce your exposure to real estate. So what's happened is those banks had a solid portfolio. Those loans come to maturity. The borrower can't refinance because the other banks won't lend them the money. Values have gone down. And now we have an issue on the bank's book. Because of that, that bank can't make another really good loan that it wants to make. Has no room for it. Can't do it. So even with good borrowers, with good projects that have existing relationship with good banks, the bank can't lend the money. So private lenders are in their heyday. So those guys go to the private lender, let's say a hard money lender, and those loans are usually solid, lower LTVs, good borrower, good asset values. Then you have other lenders that are just private lenders doing deals that banks used to do. And when the banks used to do those deals at prime plus one, that used to be a 2% interest rate. Well, now these same lenders are doing it at, prime plus 4. And that's double digit returns unleveraged. So with the same risk that a bank was taking at 2%, you as the investor can make low double digits, 10, 11, 12%, making that same loan with the same risk. That's an opportunity that we haven't seen for 20 some odd years. There are other platforms that are buying underperforming loans and non-performing loans from banks. Now, it's not truly distressed situations because the banks are not unloading them at 50 cents on the dollar or 20 cents on the dollar like they did in 2009, 10, 11, 12. They're not. They're unloading them at 90 cents on the dollar, 95 cents on the dollar. So why is that a good investment from a private debt provider? Because what's happened is there's been accrued default interest legally on that loan that's been built up. The bank has not been able to record that as income because the loan is in technical default. Borrower owes it, but the bank can't record it as income. So private lender buys this portfolio at 90 or 95 cents on the dollar, but the dollar is really worth $1.10 or 20 already. And these lenders are experienced in owning these type of assets. So in 75 or 80% of those deals, the borrower is going to figure it out. You give them extensions, you give them time to pay you back, and 75 or 80% of them will be able to pay them back. And you're making returns in the mid to high teens. On the 20 or 25% of borrowers that can't pay it back, you make a deal with them. Two types of deals. Okay, we'll give you more time. Now it looks more like equity. You're going to give us a piece of the action when you sell this asset. So now the returns even get higher. Or in some cases, there's a default. You take it back. You operate it. You have that experience. You hire all the appropriate professionals to complete the project, to market the project, to lease the project, and sell the project. And you make even higher returns. So that's a strategy. That's just a wonderful strategy to invest in today that wasn't available even 2 years ago.
Love that. Just your ability to pivot. Again, speak to how, the investor that's listening, maybe they have 200,000, roughly that they're looking to invest. How could they get in on the debt side like that? Or how would you advise somebody like that? It's like, okay, this sounds like a great opportunity, Peter. I'm on board, but I don't have the experience to go be a lender. What does that look like for me?
Okay. I think there's one way to do that, and that's to invest in funds that are experienced in doing this. So today, I don't have a fund. I just have my family office. I only invest my own money. But if it was 10 years ago, I'd have a fund that would invest in these opportunities for other people. There are a handful of those funds where I'm a strategic investor. I believe them. I love their strategy. They have tremendous company values. They work hard. They're conservative. They have their own money at risk, and they're really investing with the interests of the investors in mind, right? And there are many of those funds out there. Now, I'm not talking about public funds. Forget public funds. These are private funds. And Whitney, I've seen you at some of these conferences, and you know who some of these are, right? But these are private funds that have debt strategies. Now, many of these funds had equity strategies or continue to have equity strategies. 9 times out of 10, I would not invest in the equity strategies. only in their debt strategies, only in their credit facilities, not in the equity. Let me tell you why. It's not that the equity strategies aren't solid. Is that when you look at the difference between risk-adjusted return in the debt strategy versus the equity strategy, the debt strategy wins 95% of the time. So let me explain. So 2 years ago, lower interest rates, not the opportunities on the debt as there are today. If you had one company that had a debt strategy, same people have the equity strategy. So same people, same smart folks, same smart team. On the debt strategy, maybe they could produce investor returns at an 8, 9, 10%, which in a low interest rate environment was wonderful. On the equity side, they promised you 15% returns. Well, what happened was in reality, those equity funds didn't do so well because of the interest rate hikes, and they're delivering 8%, 10%, 12% returns on the equity side. Meanwhile, on the debt side, those same deals are happening that are even maybe safer, even with better developers. And those returns, instead of 8, 9, 10%, are really delivering between 10 to 15%. So why not take lower risk in debt and make anything from 10% to 15% net to the investor, net to me, after all their hard work, after their fees, after their promo, net to me, 10 to 15% on debt that has very low risk versus equity, maybe I'm going to get 12 to 15%. Today, to me, there's no comparison. Now, there are exceptions. I said 95% of the time, 5% of the time, there are exceptions. But if you're an investor investing 100,000 to 250,000 to $1 million, I'd go with the operators who have superiority in their credit or debt funds. That's what I would do. The other thing I would look at is on these debt funds. A lot of the debt funds that have started, let's say a year and a half ago, say in the beginning of 23, for the most part, there are no deals in there that are going to be negatively affected by the higher interest rates. They already had higher interest rates. If you go into a fund that has a significant number of those loans that are prior to 2023, there's still going to be issues, right? Now, the good news is most lending funds, especially ones that look at smaller deals, have loan maturities of 12 to 24 months. They're typically written at 12 to 18 months with extensions, right? So if you think about it, most of the deals done in 21 and 22 are already gone or restructured or sold, right? So I think if you look at these funds, it's the exception to the rule that it's an older dated portfolio, but there are some still out there. Stay away from those. Go with ones that have the new fund, the one that they started raising money for in 2023 and continue through 24.
Love the depth of just wisdom and looking at these funds, and especially now debt funds versus equity, and helping investors to think through the really new opportunities, right? As we go through the cycle that you're seeing, Peter. For time's sake, we'll have to have you back to talk about some other things. I would love to do that. But I want to jump to a couple things as well around the on your, I love the values on your website, a number of things, the qualifications for your partnerships, those things that you have just on your website. I love that. And, but from the investor's perspective, but even the operators that are listening too, what are the things that stood out to you that wowed you as an investor to say, pick the partnerships that you have? And I know there's a number of things about track record and common things we can talk about, but I just wonder, above and beyond the normal things that most investors would know to look for, what are some other things that stood out to you that whether it's even their mission versus their, the way they give back, or a bigger picture there, or is it just track record performance? What are some other things that really stood out to you about these few that said, you know what, I'm focusing on that group right there?
Yeah, so we have to be careful about this, Whitney. So I'm very much about values of these, operating partners. Like, that's the most important thing for me. Values, right? Their mission statement, their values, their people, all related to their people and their values, right? The tricky part is if you're not a big investor like me, I'm not sure you're going to get the truth versus the marketing of those values. So if you look at all these companies, they all look like they have wonderful mission statements. They all look like they have great values. All of their people, all their C-suites read like they're amazing folks. Most of them, it's more BS than truth. I don't think that investors in the, let's say, $100,000 to $1 million range are going to be able to get that due diligence done. So how do you sort through this, right? Because you don't do it the way that I do it. I send my team in. I spend valuable time with the founder, CEO, and I, offer something to them that perhaps a smaller investor can't offer. So how do they get that advantage? Here's what I think you could do. One is find out. I mean, most of your listeners have financial advisors. Put your financial advisor to work. Financial advisors today, charge you a fee based on money invested. Well, put them to work. Go have them do due diligence on their track record. And here's what I would do with track record. Specifically ask, I want to see your performance since 2019. Why 2019? Because I want to see what happened during the COVID years. And I wanted to see what's happened since the increase in interest rates. And if you get some blank answers, that's a red flag. Every one of the operating partners that I invest with has a history since 2019. And all I care about is their performance significantly better than their competitors. So if the whole industry lost 20 cents on the dollar and they made 5 cents, I like them. Not to say 5 cents is attractive, but if their competitors lost 20 cents and they made 5, I am impressed. If their competitors made 20 cents and they made 15 cents, I'm not in. Although 15 cents, 15% sounds like a good deal. So I want to see what they did since 2019 through COVID, through higher interest rates, and compare to their competitors, right? Number 2, I would get reference checks. And the reference checks need to be from people they do business with. They're tradespeople, right? They're asset managers, not their bankers. What are their bankers going to tell you, right? All sort of good stuff. But they're day-to-day people who they do business with. And ask them what the most challenging, situation was with this fund and how it got resolved, right? I want to hear the bad news and how it got addressed, right? And why you're still doing business with them. So that's something that you can do. Have your financial advisors do a lot of due diligence from 2019 and check on references that are real people who are doing business with these funds. If, for example, you hear, well, I love these guys, they take me to golf outings and we have fancy dinners, but damn, the one negative is they're slow to pay their bills, right? Red flag, right? If they say, these guys are not a bunch of fun, but damn, they're always on time and they keep their word. And let me give you 2 examples how. That's the guy I want to invest with. Does that make sense?
It does. Makes a ton of sense. I love the focus even on the tradesmen or the people they're working with that aren't even direct investors all the time, or an employee or something like that, right? You're somebody that's like receiving a service from the same group as well, right?
Yes.
and hearing what challenges they have. And I love the question of like, why are you still working with them now? Love that. Well, Peter, I know we are running short on time again. I'd love to have you back so we can jump into the health, longevity, personal development. I know you are really big on that, and we love talking about that on the show. And I just think it's so helpful for our investors all the way around, no matter if they're active operator or whether they're passive. We all care about those things in a big way. So we'd love to do that. But a few final questions for you is, you mentioned earlier helping these groups grow. Specifically, what's one big way that you've seen, bringing in your expertise, wisdom, you've been able to jump in and help groups to significantly grow, in maybe a way that they were held back, that you were able to see something they were not.
So is the question how I've helped add value?
Yeah. What's been that common thing that you've been able to step in and help them do?
One I think is investor communications. A lot of these smart guys who have a great business plan, great execution, communicate in investor reports that sometimes really suck. It's just that simple. They skirt over the issues. Last quarter report says, by next quarter, A, B, and C will happen. Well, this quarter report comes out and they don't address the A, B, and C that they said would happen. Did it happen? Did it get deferred? Did it happen as well as you thought, or different? And why? Just simple stuff like that. And I think most operators, the founder CEO never writes these reports. It's always delegated. It's always approved by the CEO usually, or by the C-suite. And they're defensive. They think their reports are good. But when I sort of point out simple things, that, by the way, you don't have to be that sophisticated to follow. You just have to pay attention. They realize, you're right. And so I've helped them communicate better and just being more clear on following up what they said they were going to do. Like we said, this was our plan, or this was our most important items, or this was the big defaulted loan that we have to resolve. Okay, well, on the next report, just address those and then tell us what's new. So investor reporting is number one. The other thing is personnel. As these firms grow, they need to hire more and better talent. And, it's sometimes hard to get rid of the guy or gal who served you well, but is not going to take you to the next level. So I've encouraged them to upgrade their personnel and at the same time acknowledge the good work that their existing team has done or teammates have done, and then put them into a role that they will continue to do well, but they're not going to help you grow the company the way you need. And so again, I think that's been a blind spot of some CEOs, where they want to keep their initial team that they put together all the way through. And in reality, that's not practical. And most of the successful companies I see are continuously upgrading their management team.
I love those answers. And man, I want to dive in even more, especially on the investor reporting. It's something that I hear all the time from our investors. We've spent a ton of time on it internally and do, right? And try to get those the best we can. I would love to pick your brain around that and even relate completely about the team and growth around that. But Peter, leave us with how you like to give back, and we'll have you back hopefully in the near future. But how you like to give back?
I hope to give back in a very significant way. And so I'd love to make impact where I can make massive impact on really two areas. One is serving underprivileged and unserved children and young families. So, that's very dear to my heart. Most who really never had a chance, or those who fell into really tough times because of situation. And are good people, young, and they may be living in poverty, or they may be living in stressful situations. I want to help them get themselves out of that situation and take their whole family, young family, with them. That starts with young childhood education, and goes all the way up through training and getting living wage jobs for the parent or parents. So it goes from all the way from the preschooler to the mother and or father in that family. So that's number one. And number two, I want to supercharge, well-educated, sometimes already successful real estate students and entrepreneurs and professionals, and supercharge their career, supercharge their success. So I not only do that with the operating partners who I invest with, I also do it with programs at two universities where we help them in real estate and entrepreneurship. In one of them, we've started a fund where the students get to invest real money in real deals. So imagine this. They go out and find deals, and they find the ones they like, and they're coached by their professors who are real estate professionals, right? They're adjunct professionals. And then they do the due diligence and make an investment presentation to like a Shark Tank of the who's who of real estate on the advisory board of this wonderful program. And some get turned down, some get accepted. And the ones that get accepted, they invest in. And then another group does the asset management on this investment for the period of time it's invested in, typically 2, 3, 4 years, right? So the students get to really invest real money. And then when the profits or losses are made, it goes back into the fund and they get to reinvest it. So I really love that. It's been a wonderful joy for me to see these. These are real estate students getting their graduate degrees, master degrees in real estate, learning how to really learn how to invest. And I've hired some of these young adults, and they're amazing. And some of the other advisory board members have hired some of these folks, and they're amazing. So those are the two ways. And the way that I fund my giving back, so I told you I have a pretty fairly substantial family office real estate fund. And I do intend to supercharge the success of those operating partners. Well, I commit 50% of the profits I make in those investments to giving back. 50%. So that's a pretty substantial amount that I get to give back. So I get a double whammy on joyful giving. One is investing in these wonderful operators and help them supercharge their success. And the money I make from that, I then take half of that and give back to those who are, needing that impact more than others. So I get two joys out of one.
That's incredible, Peter. It's encouraging to me and to others I know listening is your desire to give back in that way. And I love the learning opportunity for this university as well. And I wish I had had that opportunity early on to learn, right, in that type of environment and guided that way. And man, what a great opportunity for them and skills long term, right, for their investing. Love that. Peter, you have shared so much with us today, and I feel like opportunities that the investors should be looking out on and debt funds and how to look at operators differently and even the reporting but how can they get in touch with you, or can they, and what's the best way for them to learn more about you?
Best is my email, which is Fiorette, Fioretti at mountainfunding.com. And you can put that on your website, Whitney, if you'd like.
Awesome. That's a wrap, Peter. That's the end of the show. Thank you so much.